Hey everyone, it's Alex Morkate with realestateshorts.com. Today we're going to kick off the very big topic of commercial leases, and we'll start off by defining the different kinds of lease types. So we'll go into why even have a lease, what the different main categories of lease types are, and how they are differentiated, and we'll end up beginning to explore the concept of proportionate share. Let's get into it. Okay, so first things first, why should you even have a lease in commercial real estate? So I think that there are many reasons why you should, but I think some of the driving reasons behind why you should probably have a commercial lease from the financial perspective is that the lease is the driving force behind the amount of rent that you collect. That rent is the driving force behind how much income you collect, so revenue minus expenses. And that income is the driving force behind the value of your property. So in other words, at the very heart of the value of your property is the commercial lease. So this lease is that legal document that helps not only define what party is leasing to whom, but also who is responsible for what are the ground rules for this working relationship between owner and tenant, and again financially, which party needs to pay what to whom and when and under what circumstances. And so it's really that last part that we're going to focus on in this first episode to help differentiate between the different kinds of leases. So let's start off by first defining the three main buckets of expenses and rent obligations that one or both of these parties could be exposed to. So the first, I think, is the most obvious, and that's base rent. So the tenant has to pay the owner some rental amount for occupying space in their building. So we'll call that base rent. In this example, let's say the tenant wants to occupy 5,000 square feet in an office building, and the rental amount is $25 per square foot per year. So the product of the two is going to be $25 times 5,000 square feet for $125,000 of base rent annually. Now, the next piece that's important to differentiate between who pays what is operating expenses. So as you well know, operating a building comes with a cost. Taxes, insurance, utilities, maintenance, management, and so on. And so in this case, we'll kind of group them into three subcategories. So under operating expenses, we'll have real estate taxes, insurance, and this catch-all umbrella category called common area maintenance. So in this case, common area maintenance is that bucket that includes all the other items that are not real estate taxes and insurance. So again, landscaping, security, maintenance, utilities, and so on. So now that we've defined operating expenses and what is a subpart or a component of operating expenses, we've now defined that second kind of category. The last category is capital expenses. So the main difference between operating expenses and capital expenses is that capital expenses are long-term in nature. They tend to improve the value of the property, and oftentimes they are either unforeseen or unknown. So let's say, for example, the roof may need to be replaced at some point in the next 5 years. You don't really know when, and you may not have a firm estimate of how much, but at some point that cost will occur. So you could define that the tenant is responsible for paying the capital expense of roof replacement when that expense arises at some point in time. So in this example, we're saying, let's say it's $50,000 worth of roof repair in year 2. If the lease calls for it, the tenant would be responsible or the landlord would be responsible. The lease would simply define which party is responsible for paying for roof replacement and expending the $50,000 worth of expense. So let's take a look at how these categories help us define the different main buckets or main types of leases. So I think there's really three main types and then a myriad of subtypes. So the first is what I'll define as full service or gross. I understand some people are probably going to get a little uncomfortable with me and my use or definition of that first category. And this really ends up being a geographical custom. Some geographies, some markets, some market participants may define gross differently or full service differently from one geography to the next. So let me elaborate. What I mean by full service is the tenant is responsible for paying only base rent. They have no responsibility to pay operating expenses or capital expenses. All right, so next is net lease. So a net lease implies the tenant is responsible for paying 100% of their base rent, as well as either some or all of their fair share of operating expenses. Next in line is an absolute net lease. In this lease structure, the tenant is responsible for paying their base rent, their proportionate share or fair share of operating expenses, as well as their proportionate share or fair share of capital expenses. So again, full service means tenant pays only base rent. They don't pay operating expenses or capital expenses. Net means the tenant pays base rent and their share of operating expenses. They do not pay any capital expenses. Finally, absolute net, where the tenant is responsible for paying their share of all three of these categories. And I think it's from here that we can begin to split the world and the universe of lease types a bit further into subtypes. So we could have at one end of the spectrum, all the way on the left, gross or full service. And at the complete opposite end of the spectrum, we have absolute net or bondable leases. It's that gray middle ground that tends to get most people into a frenzied debate and certainly negotiation between tenant and owner. So I think a very common term that we'll hear is a triple net lease, where the tenant is responsible for paying the base rent plus the proportionate share of operating expenses. The three nets, the triple net concept, again, comes from this definition or this segmenting of these three categories of expenses: taxes, insurance, and common area maintenance. And so from there, I think it's a pretty natural extension to define, let's say, single net as being base rent plus one of those categories, or double net being base rent plus two of those categories. And so you could find a quote double net lease that says tenant is responsible for paying their base rent plus a portion of real estate taxes and, let's say, utilities, or real estate taxes and insurance, or some combination of these multiple expense categories. The ones that get a little hazy are modified gross and base stop, and these are a variation of a sharing of expenses through time. And so again, we'll speak a lot about these in another video. So for now, I think the spectrum is probably the main focus of this episode, because it should be obvious now that as you move from one end of the spectrum to the other, let's say from left to right, from gross to absolute net, there is a redistribution of who is responsible for paying different expenses. And therefore, it's also a redistribution of risk and a sharing of risk between one party and the other. So let's say, for argument's sake, you believe as an owner that insurance may go up, or that utilities are probably better managed by the tenant than by you. Let's say it's a specialty restaurant. And so in doing so, you're finding a way to shift the responsibility away from you onto the tenant so that they can manage it better according to their business line, or so that you can manage it, because in the insurance example, Maybe you have a better insurance carrier and lower premium than the tenant may. So all told, I think being able to shift responsibility is one of the motivations behind choosing one of these lease types versus another. But understanding the spectrum as a whole can give you some context about first what these options are and what that would really mean for one party versus the other. So we'll begin to wrap up with an introduction in the concept of a proportionate share, pro rata share, or fair share. And so I think a really straightforward example is if this tenant occupies 5,000 square feet in a 10,000 square foot building, they occupy half, 50%. And so if all the operating expenses are $70,000 a year and it is a triple net lease, the tenant would be responsible for paying half, their fair share, their proportionate share, their 50% of that $70,000. And so as an alternative, let's say they only occupy 4,000 square feet, 40% of the proportionate share, then that means they would have to pay 40% of that total expense obligation. 40% times $70,000 gives us $28,000. So pro rata share goes a long way to help define which party is responsible for what expense repayment based on the occupied area of that tenant relative to the balance of the space in that asset or property. So to recap, we've covered the introduction of the different kinds of commercial leases. We're defining that spectrum within the context of a gross or full service, net and absolute net lease, the distinction between them being which party is responsible for picking up the tab, managing, and ultimately paying for the operating expenses or capital expenses on a property. We ended with pro rata share, and from here we'll certainly build up into the more complicated lease types, the more nuanced lease clauses and applications, so that we can begin to round out the global topic of commercial leases. So if you found this video helpful, there are a handful of other related videos that I would call your attention to. As always, if you have any questions, feedback, or comment, we'd love to hear from you. Thanks again.